Awaiting our most current read on initial and continuing claims. These aren't lagging indicators. These are forward-looking. 166,000. Wow, welcome to the 1960s. Haven't been at these levels since the late 1960s. And on continuing claims, a bit of a different story. 1,523,000. That's well above the estimate, and that's well above their comp to the late 1960s, which happens to have been last week at 1,307,000. Now, I do want to caution, if you notice that some of the history on these two data points doesn't match what you've saved, it's because they've done 4 years of benchmark revisions from 2017 to 2021. So things are a bit different, adjusting for new seasonalities. We are getting more revisions, which doesn't surprise me. So last week's 202,000 now drops down to 171,000. And that 1.307 million, that was the lowest level since the 60s, now jumps up to very near current levels at 1,506,000. So make sure you check some of your spreadsheets. And we see that the yield curves have steepened. Do we want to play that famous parlor game of predicting recessions? You could do that if you want. But what I'm noticing is, let's see, we're looking at about a 2.25 to 2.5 Fed funds rate at the end of the year. Where are 2-year notes? Where have they peaked? Basically right on the southern and northern borders of 2.5%. Now they're starting to work their way down. That shouldn't be shocking. Yield curve steepening most likely will continue. And with regard to claims, I bet you the Fed's going to, at some point in a couple of quarters, pay a whole lot more attention to them to see if their tightening cycle or some of the horrible energy policies that have gotten us bind start to show up in the numbers. Joe?